We're an association with a heritage of DB members, and we should be taking the lead on this. But now we're going to hear about the big issues affecting both DB and DC, as I'm joined by Faith Ward, who is Chief Risk Officer at the Environment Agency Pension Fund, Mark Fawcett, who is Chief Investment Officer at Nest, and Robert Waugh, Chief Investment Officer at RBS. Welcome to all of you, and welcome to our live web stream viewers, because this session is being shown live. The panel are going to talk about four main topics in this session, and they are climate change, governance, some macro issues, and if there's time, something about structural change in pensions. And we really want to draw in you, the audience, to this discussion, and both here in the room and on the live web stream. So we're going to pause for comment and questions after each topic. So please be ready as we proceed. So let's start with the first topic, which is long-term climate risk. Now that's something that keeps many non-pensions people awake at night. As pensions people, how do you feel about it? And are you taking any actions to manage the risks? And I'm going to ask Faith to lead on her views on that.
Thank you, Lesley. I think you're right to say about the concerns of sort of the wider population. I mean, last November we had literally hundreds of thousands of people took to the streets on the run-up to the Paris summit, looking for the global policymakers to take decisive action to tackle climate change. And it's probably unsurprising, given who we are and the fund I represent, that it is the most frequent challenge to our investment strategy. What is our fund doing about climate change? Fortunately, we think we've got a good answer to that. It's not as radical an answer as some of our members were expecting. We came under a lot of pressure around the disinvestment campaign and to exit and to disinvest completely from some fossil fuels and high carbon emitters. But that wasn't the right strategy for us. We did a lot of work looking into the whole risk spectrum and what the implications of tackling these issues would be. And our approach is much more nuanced than that. It's sort of combining sort of decarbonisation, investment and engagement. It's very much informed from the top down by the work of Mercer, which I'm sure you'll hear about later on this afternoon from James Ambish's team on investing in time of climate change, and also bottom up, looking at our carbon emissions and fossil fuel exposure. But very much risk-based, very much evidence-based, and looking at what might threaten long-term returns. And it is very much sort of hardwired into our perception of fiduciary duty and looking after our members' best interests. There's obviously a lot of detail and behind all of that, which we don't have got time to go into today. I have brought copies of our policy, which does capture a lot of this. If anybody wants to talk about it afterwards, I'm more than happy to go through that detail, because it is a challenging and complex issue, many different facets to it, but we do feel as if we've come up with a kind of quite a pragmatic, risk-based approach to tackle what is actually quite a complicated and very important issue for the trustee agenda.
Okay. Mark and Robert, do you have any comments on climate change?
So this is something we're very much looking at. I think, we've seen providers sort of launch indices, initially very sector neutral, very tight tracking error to sort of world indices, and we felt that the industry needed to move on and be a bit more progressive. So the sort of second and third generation are starting to, for example, exclude, say, coal, for example, which is most likely to become a stranded asset, focusing on companies, even the carbon-heavy companies, which are more progressive in terms of trying to manage that carbon risk, and then also thinking about overweighting companies that are more proactive, maybe renewables or whatever. So we think there's a way to design smart indices that you can either track or have actively manage against, which better manage the long-term risks of climate change.
Okay. Robert, anything?
So I think you need to split the problem into two, or I find it easier to because it's then simpler. The first is there a risk to the assets we own? And we find the best way of dealing for that is to engage. And we are signed up members of the Coalition for A, which is a coalition which is trying to get better information out of companies. Last year we got a 98% acceptance at BP, Shell, Statoil. This year we're going for Anglo American, Glencore, Rio. I encourage everyone in the audience to participate, to vote in favour of these things, because if we get the information, we can then make informed investment decisions, and that's what's important. It also brings the agenda further up management boards. But the second thing we can do, which is not to do with our assets, but is to do with our social responsibility as major asset owners, or arguably how do we try and save the world from this problem, is to provide capital to areas that are helping. So we own 4 wind farms. Wind farms are a great investment for pension funds. You can get an 8% unlevered return. You've got inflation linking through the power prices if you choose to take them. You can also hedge the power prices out for about 1%, take 7%. That looks like a better return than anyone was suggesting yesterday, or I would suggest today in terms of equity returns. You're taking wind risk, which is a diversifying risk, against the other risks you've got in your pension fund. We're also looking at solar. You can look at areas like waste to energy. We have a large timber portfolio, which is all fully sustainable timber. So there's loads of things you can do where you're doing your fiduciary job as enhancing return per unit of risk, but still at the same time providing capital to new areas. Dealing in secondary equity markets provides no capital to anyone. It just moves capital. I can sell my stock to market, it will make no difference to anyone. Divestment, secondary equity, I think is a complete waste of time.
Okay. Anyone? I'd like to now open this up to the floor for comments and questions. Are there any, or are there any on our I don't think we've got anything on our live web stream yet. Does anyone in the audience have any views on the risk of climate change? Okay, I'm going to ask a question because I'd like to understand how much we should reasonably be paying to manage climate risk.
I'll pick that one up perhaps to start with and say it's not, perhaps turn the question around and say, do you actually know how much climate risk you have in your portfolio? Are you being rewarded? You can't know how much you should pay unless you know how important or risky it is to the assets. And as quite eloquently outlined by my colleagues here, that we need to look at it across the whole of your portfolio. It's not, as you say, just isolated to fossil fuel companies. It's the risk to your real estate portfolio. There's this excellent research out there that sort of clearly demonstrates the fact that there's the sort of population sort of moves to coastal cities and a risk from, it's going to cost over in the region of about 9% of GDP in the foreseeable future. So there's some quite significant long-term risks associated with it. So I think it's more a case of, do you actually know what's your level of risk and what's your reward, and therefore how much should you pay to manage that?
Okay.
Yeah, I think data is a real issue. I mean, it's improving, but as Robert says, we need more and better data to be able to understand what those risks are. And the danger is you make judgments based on very incomplete knowledge. You can never have complete knowledge, but making sure you really understand the problem.
Yeah, so I don't think you should accept a lower return, but what you should do is spend enough money to get the information you need. So, for example, most of us will have real estate portfolios. Do you know what the carbon footprint of your real estate portfolio is? We know that we use 40 tonnes less carbon in our real estate portfolio last year than the year before. You can ask your real estate managers for that information. They can provide it to you. They should have that information. It's not up to us to have to invest more costs, but our managers should be doing their job there.
Okay, I'll just give you in the audience a chance again and ask you whether you have any comments on climate or questions for the panel.
It was a heavy night.
It must have been a very heavy night. Is there one? There's one here. Thank you.
Yeah, I'd just be interested to hear if the other two panellists also agree that divestment is a waste of time.
Okay.
I will definitely take that one first. We have done what's called selective disinvestment, so it's looking at a risk-based approach. One of the things we looked at when we analysed our portfolio from the bottom up and looked at our carbon emissions and fossil fuel exposure was actually a lot of our active managers were kind of managing that quite well, although they did hold some stocks, but they had a good rationale and they knew exactly what they were doing around there. But in the passive portfolio is where we felt that there was more risk that we had less control over due to sort of the market, the way the markets define what the constituents were. And that's where, for example, our value portfolio had 6 times more fossil fuel and carbon exposure than the underlying developed index. And that's where we've taken action, and we feel that having smarter indexes around that space, whilst, as Mark indicated, managing the financial risks and the product we have is only 30 basis points tracking error. So we can manage the financial risk whilst massively reducing that exposure, which does lead to some disinvestment. although it's smart in the sense that because it's zero weights rather than excludes, it does mean it allows for sort of future proofing. So if we do get some of the technological advances, if we get carbon storage and capture, if we get sort of changes in perhaps the balance sheets of these companies, those organisations will come back into the index. So it has that kind of sort of future proofing element of it. So I think selective disinvestment is an appropriate part of it on a risk-based investment driven perspective. I think that's appropriate, and certainly disinvestment from within the balance sheets of the underlying fossil fuel companies in terms of pulling away from projects that are just not even at break-even point. They are just there to make sure that the capex is well spent, and therefore them selectively disinvesting from some of their areas, which is why we use the word decarbonisation, because to give you an example, what decarbonise rather than disinvest means is that I might own exactly the same amount of BHP Billiton in 5 years' time, but the amount of carbon that they have in their balance sheets will we anticipate to be considerably less. So it's not about moving away from those companies, but working with them as to how they can transition to a low carbon economy.
Okay, Mark.
So I broadly agree with everything that Faith has said. As a wholesale strategy, disinvestment doesn't work selectively. I think it can be useful.
We've got one more question at the back.
Chris Hitchin, Railways Pension Scheme. I think many of us still day to day feel we do end up with a dilemma between doing well and doing good. So I was wondering whether the panel felt that the way to actually resolve that dilemma is to try and really be more long-term in our thinking. Do these things join up if you look far enough out?
Yeah, absolutely. I mean, these are not... We do not view climate change risk as a non-financial factor, and it's not to try and save the world, but we're thinking about how to manage this risk. We're investing for our members. The youngest of our members are 17 and 18 years old. By the time they come to retirement, the climate change risk will have increased very significantly.
Okay, any other comment on that? Thank you. I'm keen to keep moving through, so I'd like to move on to our second topic, which is covenant. Disruption is clearly the major theme of this conference, and particularly disruption in the asset management industry. But what about disruption for scheme sponsors? What should schemes do about that? And I'm going to ask Robert to lead on that.
Thanks, Lesley. Yeah. So Sir Tim Berners-Lee was here yesterday, and he was talking about the pace of change getting ever faster, and there's some great books on this, The Second Machine Age, Race Against the Machine. The average company in the S&P pre-World War II had been in the S&P between 70 and 90 years, depending on what data and which date you take. By 2003, that had fallen to 25 years. It's now 15 years. In the last 10 years, we've seen the banks get bailed out. We've seen General Motors get bailed out. We've seen newspaper circulation fall 40%. Last year, BP made £2.2 billion. This year, it barely broke even. Anglo-American in 2011 made more operating profit than its market cap today. The pace of change of corporate world is getting ever faster. And if you go a stage further, it's not just the old economies. Take Nokia, which was obviously, a fallen angel. But not only did it fall, but when Microsoft bought it in 2014, they paid £7.2 billion for it. They wrote all that £7.2 billion off last year. So the rate of change in the new world economy is even faster than the rate of change possibly in the old world economy. And if we look at the market capitalization of Facebook, Alphabet, one thing that doesn't change is people changing their names to weird and abstract things, Google to most of us, and Amazon, they're now valued at over $1 trillion. What does that mean? That's 45% of the FTSE 100. And what intrigues me about them and a lot of the technology startups and the unicorns out there is none of them make anything. Most of them are there to make our lives easier or to irritate us through our children. What they actually do is they increase global competition, they increase accessibility to information, they increase price transparency. And what all of this does is it reduces profit pools, it reduces profit margins. Airbnb reduces the profit margins that hotels can make. Uber reduces the profit margins that taxis can make. They're not giving us services that didn't already exist. They're giving them to us at a cheaper price. That means other people are losing out. Basically, the cake just got smaller. Someone else just ate the first piece. Why should we care about this as a pension fund? Well, most of us have got recovery plans that extend for between 8 and 15 years. And I think the question you have to ask yourself is, are the companies who are our sponsors going to be able to finance those plans at those points in the futures? Or are there scenarios where they can't? So the title of this session is What's Keeping You Awake at Night? What's keeping me awake at night at the moment is a weird piece of European legislation called PSD2 that I'm sure no one in this room will have heard of, and actually most bankers haven't heard of. Some of you will have heard Sir Tim Berners-Lee yesterday talking about what he did with his bank statements by downloading them. That is what PSD2 is going to do to everyone. So it's going to give you access to your bank data, and it's going to give other technology companies and other companies who want to compete with banks access to your bank data. So the banks are going to have to free up their data on what's called an API, and you can then work out whether you took that taxi that you charged to expenses and tie it in with your GPS signal if that's what you want to do. Why is that keeping me awake at night? Because I think the next crisis is different from the last crisis. I think when we do covenant analysis, we now need to move beyond just looking at the balance sheet and looking at today's profit and loss for the companies who are our sponsors. And I think, for us in the banking sector, we need to start looking at fintech, and that's what we're doing. We need to run scenarios of what the future shape of banking looks like, and what does that mean for our sponsor? What does that mean to profitability? You can't run one scenario because there are many different outcomes, but we need to run those outcomes, and then we need to work out what is your investment and funding strategy against those outcomes. And what are the triggers you're going to put in place that are going to change your flight path because you've moved from one scenario to another. And I'm going to finish with the words of an ex-colleague of mine who's chairman of a few FTSE pension funds. He said to me once, he said, Robert, there's no such thing as a strong covenant. And I realise I'm sitting by someone who actually is controlled by the government, so there's one such thing as a strong government, but no such thing as a strong government. There's just weak covenants, and those covenants that have yet to become weak.
Do you have any comment on that? Mark's shaking his head.
Can't follow that, really.
You can't follow it? No. Anyone from the audience have any comments on Robert's statements? I'm looking, I can't see any hands up.
I'm be awake on my own, doesn't it?
It looks like you're awake on your own, yes, indeed. How should we, to what extent is covenant risk actually manageable? Compared with other risks, I suppose.
Well, I think it's as manageable as climate risk, isn't it?
Oh, I guess so.
I think it's about dialogue. It's about having that openness and transparency, and that's one of the themes I think that's coming out quite strongly across the conference is that communication and trying to keep that dialogue open and an honesty between where you're at. It can't solve it, but it tries to reduce the number of surprises perhaps that are around the corner and having that kind of really good relationship with your sponsor.
So I think you can work out what your financial exposure to your sponsor is fairly easily at different points in time. Okay? And what you've got to work out is that exposure to your sponsor proportionate to your other risks? And for virtually everyone in this room, the answer will be no. Their exposure to their sponsor will be far greater than their other risks. And yet most people in this room are de-risking by selling growth assets and buying gilts. By selling growth assets and buying gilts, you are increasing that exposure to your already biggest risk, which is your covenant.
Interesting discussion for the DB task force. Yes, Robert.
Robert Brown from Willis Towers Watson. I think I agree actually with a lot of what Rob said. I think there's a danger that when we're thinking about covenant, that people always think in the present. They always say, yeah, it's really, really strong. But again, if you particularly with banks, dangerous area because they look very strong until they're not, bluntly until they're not. They're very binary. I just have one question for Rob actually, which isn't related to covenant, but the comment you were making around the advance of technology and what it was doing in terms of profit pools, it seems to me, or feels to me, that's quite a deflationary environment. I just wonder whether you agreed and what you thought the implications of that were.
Yeah, I completely agree. I think that the two big deflationary factors in the last 2 decades have been the introduction of the Chinese labour force into the world market and technology, because actually, the price transparency means that we don't end up overpaying for products. I was at a presentation a few weeks ago from the guy who invented the morph suit, and he sold them. And what amazing, young guy, very impressive. And his business has only been up and running like 6 years. Within 4 years, he was selling morph suits in 23 countries. Now that is inconceivable only a decade ago. This is what the internet has done. He has access to global markets. He's globally sourcing from China by going one flight over there. This is hugely deflationary across the piece.
Looking for any other comments or questions from the audience. There's one at the back there. James, if you don't mind, please.
There were some interesting comments there on covenant. Would the panel like to comment on thinking about how covenant and investment fit together? So when you're thinking about integrated risk management, as the pensions regulator would like us to, perhaps the missing link in the triangle is covenant and investment. So would you like to comment more on that?
Yeah, everyone's looking at me. So I think you need to integrate risk into it. So what is our role in running a pension fund? Our role is to maximise the probability of the pension fund being to pay all its members all of their pensions until the point they die. That is our role in life. How do you maximise that? You maximise that by ensuring that you never end up in what I call the vicious spiral of a pension fund, which is where the pension fund deficit gets so large that it damages the covenant of the sponsor. That is when you hit the vicious spiral. And you can integrate your investment and covenant quite easily in that, because you can work out how much risk you're running in your investment strategy, and you should run as much risk that under a deterministic stress scenario you can rebalance for a fall in markets and still not damage your covenant. And as soon as you get to the point that under a deterministic scenario you're going to damage your covenant, you should start to de-risk. And you've got to do it at that stage, because you don't want to be doing it at the stage where you hit that deterministic scenario and your deficit's gone through the roof and your covenant can't afford it. So that's how I think you should integrate it, but I'm sure other people have other opinions.
Yeah, I mean, being a DC scheme, we don't have the covenant, but we have a similar issue in the sense that it's the members who are contributing, so they take the investment risk, and the risk to their funding in the future is partly the investment risk and partly their ability to make contributions. So one of the ways we think about it is, how do we diversify the risk that they don't or cease making contributions, unemployment or things like that. So we thought about, for example, when we looked at our equity portfolio, we didn't want a home bias in our equity portfolio because that would give people more UK economic risk relative to the rest of the world, and we wanted to diversify that risk in a reasonable way. So we are country neutral in terms of our equity portfolio. So although the covenant risk would disappear over time as DB schemes mature and close, the same issues are faced by DC members, which is the future of pension saving in this country.
Right, I can't see any more questions from the audience, and I think our audience at home or in the office on web stream had an even heavier night because there are no questions coming
there are millions
online.
of people watching this.
So let's move on to topic 3. Macro issues. There are lots of macro issues to worry about, and some of them I referred to yesterday. We've got China, interest rates, Brexit, and the oil prices. A great handful for you to pick from, and I'm going to ask Mark to lead on that.
So we've got a limited amount of time, so I'm not going to try and cover all those issues. So I think the thing I really thought we should focus on is are people thinking beyond the short term? Because the news is just full of sort of pointless discussions as to whether China is growing at 6.5% or 7%. And Mervyn King was interviewed last week. I guess he's promoting his new book, and he just said we can't actually measure GDP to a decimal place. So given we can't measure it, there's no point forecasting it to a decimal place. And we need to think about what the long-term outlook is and think about long-term returns. And are we being paid for the risk that we're taking? So, for example, if you think about credit markets, low interest rates are causing people to move away from government bonds, which are extremely low yielding, into private markets and loans and all these sort of alternative credits. And do people really understand the risks they're taking those in those portfolios and in those asset classes, because for a lot of people they're relatively new, this is traditionally an area that banks would operate in, and suddenly pension funds are operating in them. And are trustees clear on what risks they're taking? And although it's a slightly different market, Adair Turner was pointing out that the crowdfunding has exploded, and people just don't understand the credit risk that they're taking by doing that. It looks like an attractive return, but what are the consequences of things going wrong? And liquidity is, I think, a big cause for concern, but at the same time, DC funds or long-term investors don't need as much liquidity. So on the one hand, people go into these very illiquid private markets where they don't necessarily understand what the credit risks are, and then they really want a lot of liquidity in other asset classes, and get very worried that liquidity isn't there. So the corporate bond market, there's been a lot of stories in the press about how liquidity is very bad. So I was talking to a credit manager last week, and he was saying in his 20 years experience, liquidity in credit markets has never been as bad as it is now, because the investment banks are withdrawn. And that makes investors very worried. But then I asked him, are you being paid for the illiquidity risk? And he said, absolutely. If you're prepared to buy and hold, you're being paid for that risk. So we understand the corporate bond market very well. It's a very mature asset class. That should be potentially an attractive asset class. But people are going into these more opaque asset classes, happy with the illiquidity there, but not happy with the illiquidity in corporate bonds. And just to give you an example of how sort of dislocated the corporate bond market has become, Apple issued a sterling bond last year at 90 basis points over gilts. It's now trading 170 basis points over gilts. Right. So, Apple's maybe not selling quite as many iPhones, but I don't think Apple has a high default risk. They're issuing corporate bonds because, managing their tax and their cash and stuff. But why has that spread increased significantly? Was 92 cheap? 180 looks pretty good value to me. So I think understanding, are you being paid for the risk, is important, and understanding where the risks are that you're taking.
Anyone else on the panel have any comments on?
We very much sort of agree with Mark's perspective, and I think from a pension fund perspective, we've never had to work harder to identify other forms of sources of growth. As outlined, the long-term prospects for growth globally are quite very lackluster, and therefore we're having to work really hard, and whilst at the same time trying to find those alternative sources of growth, managing some of the other risks that come along with that is quite a challenge, particularly for trustees to try and get their heads around these new asset classes. Certainly for ourselves, we have embraced this illiquidity premium. We've looked into private debt, again, stepping into that market that is being exited by the banks and taking advantage of that, but cautiously and tentatively. Also, again, similarly to what Mark was saying about buy and maintain, and that's again another theme that we've done with our corporate bonds, is to actually go with quite an explicit buy and maintain type strategy with our corporate bonds, and again taking advantage of some of these other shifts. But it is challenging. I think the challenge for pension funds has never been as great to try and keep all of these issues in check and to do a good job.
Robert, do you have anything?
Well, I'm not sure I agree, actually, but that's sort of becoming a bit standard.
Let's have an argument.
You see, people sit up here and they say, equity returns have gone from 8 to 5. I agree with that. But 30-year swaps have gone from 4.5 to 1.5. So, I did my first valuation in this job in 2010. And bottom up, we work out what our assets are going to do. And we come up with a growth asset return of swaps plus 3. I did it in 2013. We came up with swaps plus 3. I did it now. We come up with swaps plus 3. We're not trying to come up with swaps plus 3, but the answer is actually your risk premiums are exactly the same. What's happened is that nominal bonds have fallen. Now, what we care about is outperforming our liabilities. Our liabilities were growing back in 2010 at swaps plus 1, let's say, so 5.5. Now our liabilities are growing at swaps plus 1, so let's say 2.5. So actually our return above our swaps is as high as it's ever been, as long as you've got your growth assets. So assets against liabilities, you haven't got a problem. The problem is your deficit. So the problem is your starting point, not actually your asset returns, to my mind. So if you were fully hedged in 2010 and you kept your growth assets, you actually would have done absolutely fine till now. Your returns in growth assets would have been good and you wouldn't have taken a hit on your swaps, and you'd now be sitting there with a pretty much bang in line with your flight path, because actually your return on your growth assets is still 3% above your swaps. So I think everyone gets a bit miserable about nominal returns. We're in the pension fund industry, we have to outperform our liabilities, not a nominal figure.
Do you feel differently from a DC point of view?
Well, we don't have an explicit liability. It's harder to measure, but clearly our members, in some sense, have a liability, and we want to generate good returns for them and manage the volatility along the way. Now, we don't have a sponsor saying that's too much volatility or not enough, but we clearly need to generate returns, and we're just trying to identify along the asset classes where we can get those returns. So, we have, in some senses, a bigger risk appetite than your average DB pension fund. We've got 50% of our portfolio in equities, we've got 20% in property, and virtually nothing in government bonds. So I agree to the extent that we are definitely seeking returns through risk assets. Sometimes returns don't look quite as attractive, I suppose would be.
I think it's much tougher for DC. I completely agree with Mark. I mean, DC, you want real returns, and your real returns have come down because what's happened is, real rates have come down. So actually, your return from a real perspective is really difficult for DC. So we have a DC plan, and we're looking to do inflation plus 3 to 5. We're going to struggle to do inflation plus 3. There's no way we're going to do inflation plus 5.
So it's interesting. When we came out with our objective back in 2011, we said for our growth phase, inflation plus 3 was our objective. And people said, well, that's not very taxing. You can do that easily. Now, it can be quite challenging.
Anyone in the audience like to comment on wider risks? Luke.
Hi, yes. On macro issues, the rise of Donald Trump is well chronicled, and we're also seeing populist politicians thriving across Europe. Does the increasing plausibility of pitchfork and flaming torches politics keep you awake at night?
He's like,
I'll take a stab at that one. It's politics, always dangerous. I think the growth in anti-establishment parties and anti-establishment politicians is not just a US phenomenon, but clearly a developed world phenomenon. I think you've got to ask yourself, why is it happening? Now, if Bill Gates was come in the back door there, the average wealth of everyone in this room would have just gone up by, and everyone on the wires, would have just gone up by $100 million each, which would be really nice, except none of us would feel any richer whatsoever. And this is exactly what has happened in the United States of America for the past 20 years. So the US median family income in real terms has fallen 10% between 1999 and 2015. So the median family income is 10% worse off than they were 16 years ago. That's a really scary concept, yeah? All of the wealth generated in America, all of the growth in GDP, has gone to the 20% of the richest elements of the population. 40% of the wealth has gone to the richest 1%. So it's not surprising that people feel a bit duped. They think that the establishment is out to get them, and they want to change that. And it's not just in the States. In the UK, for example, the worst performing socio-economic group for educational attainment is white British poor. Okay? If you leave school at 16, or if you left school at 16 in the UK, you have a 35% chance of being unemployed. There is a complete correlation between growth in wealth and educational attainment. And so we have the bulk of the population feeling that the world or the country is not working for them. This means in a democratic society that people will vote with their feet, and democracy will challenge capitalism, because capitalism is not working for democracy. That is leading to this growth in the anti-establishment parties and individuals. That could lead to protectionism, that could lead to reductions in mobility of labour, and it almost certainly is very bad for stock markets.
I
think I come from a slightly different perspective, although I don't disagree with a lot of what you've said. I mean, I think a lot of it stems from fears, and those fears, as you say, from the breakdown of trust in those establishment parts of that picture. And I think, does it keep me awake at night? I think I try and turn these things around in my head and think about, well, what could we actually do, particularly in our industry, and how can we contribute to that? Because I think obviously one of the main parts of the establishment that there was a breakdown of trust was on the financial systems, and that has very much contributed to where we are at today. And I think there is a demand on everybody in this room to look to their own culture, their own behaviours as to how we can rebuild trust in our financial systems, how we can rebuild trust with our beneficiaries through being more transparent about what we do, about between the asset manager and the asset owner, about that trust, about sharing things like costs and understanding and making sure that your clients really understand what they're buying, what the costs are. I think we really do need to build on those communications if we're going to rebuild trust in our own industry, and rebuilding that trust amongst ourselves will help to stem that fear in that particular part of the establishment. And I think that is something we can actually practically do to stem this tide of fear that is fueling these more sort of radical approaches to political parties.
Okay. Mark, do you have any comments on that?
So I don't really comment on politics, given who we are. And as my partner's half Mexican, you don't want my personal views on Donald Trump, would you?
I think you just did comment. Anyone else in the audience? If not, then I will move on to our last topic. And I doubt that the audience was expecting us to raise this in a session that appears to be about investment risk, but we've experienced some massive structural change in pensions recently, albeit that the next week's budget is saying that we're not going to hear any more about pensions, but we've still seen some huge changes. As those responsible for investment and risk, do any of those worry you? Or is it just an admin headache?
Maybe I kick off. So even before the freedom and choice legislation came through, before it was announced in the budget, we were thinking that for someone retiring at 65, buying an annuity straight away, if they had a life expectancy of into their 90s, was probably not the right thing. They should probably be thinking about investing further and into retirement. So we absolutely think that there's a need to develop products that basically give people a sort of sustainable income for the whole of their lives, but you carry on investing through at least some of that. So we published what we called our retirement income blueprint last summer, and it's basically got two elements. One is a sort of a drawdown portfolio in the first 20 years, and then there's a longevity insurance we call later life protected income at the back end, 85 onwards. And the thing that keeps me awake is not the drawdown. I mean, there's a sort of known investment problem. It's not without risk, but we think you can manage that portfolio in a sensible way that delivers sustainable, likely inflation-linked income. It's getting the longevity insurance, and we've had conversations with insurance companies who wrote traditional conventional annuities, and there's very little appetite, if any, to write deferred annuities. And so we're thinking of other ways that you might deliver that later life protected income. But it would make sense. The annuity market has collapsed. People don't like buying annuities at 65. But having that longevity insurance is really important. People cannot manage their longevity risk for the whole of their life. And therefore, I'm really hopeful that market will develop.
I mean, probably from my perspective, my role is much broader than just our investment strategy. So no, it certainly is one of the elements on our sort of risk agenda. And I think for us, it's making sure that the momentum and everything that we've gained from auto-enrollment, that whole move that we have to culturally get people thinking about saving for their retirement, saving for the long term, and that I think we want to keep all the positives going on that, and really are quite cautious and slightly concerned about any moves that kind of make that trend go backwards and protect, let's say, all that advantage that we've got in encouraging people to save for longer. In terms of our own fund, anything that sort of threatens the kind of attractiveness of our scheme, reduce membership is reduced cash flow then sort of changes the basis in which we have to kind of make decisions. So it really is quite core, is keeping our sort of membership, keeping the attractiveness of our scheme sort of looking good. And I think for us, the what does keep us up at night, quite literally, is trying to keep up with the communication with our sponsors, with our membership, with our beneficiaries, making sure they really do feel equipped. And again, this whole transparency, this trust, it challenges with this change agenda is to try and keep them so you feel as if they're well informed about everything that's going on. And I think we've already got some pretty significant changes to deal with contracting out and explaining that and how that's going to impact on them. And I think that for us it's about that communication challenge and making sure that they feel in control of what's happening. It definitely is one of the things that keeps us awake at night.
Robert, what about you, or do you just leave it to the admin people to fret about?
Well, no, I wouldn't want to put it that way. So the main issue for freedom and choice is what it does to your cash flows. But one of the things that intrigues me is, so our transfers out have gone from 0.3% a year to 0.7% a year on a current run rate. So nothing that's actually really causing you any stress. It's sort of intriguing though, because I also chair the DC scheme. On the DC scheme, we're seeing about 95% of people take cash. So they don't want to buy annuities, and yet the DB people don't want to sell their annuities. And there may well be that there's a price differential between the two, that's rational. It may well be the DC people have actually also got a DB pot, we just don't know. But it's kind of strange that you've got these two people behaving in diametrically opposed ways. It may just be the usual apathy towards pension funds, that you take what you've got and you don't ever change it. But that does mean we're not doing a good enough job to make sure that everyone gets what they need, because there may well be more people in DB who actually would do better with a flexible drawdown, and there may well be more people in DC who would be better with some longevity hedging.
But there's a lot of behavioural biases here, right?
Yeah,
it's the endowment effect. So I've got my DB scheme, so I'm going to keep that, right? I'm not going to part with this big pile of cash and buy an annuity and give it to an insurance company, because I may get knocked over by a bus tomorrow. It's amazing how many buses have to knock people over to make that work. But you know, so people just won't buy voluntarily an annuity. As well, I mean, obviously a few people do, but it's behaviourally, it's very hard to hand over all that money.
Anyone in the audience have any comments on that we're talking about? Yeah, is that one at the back there? No?
Yes.
Yes?
Yeah.
Yes, thank you.
How do we use behavioural finance to nudge for good?
Yeah, so I mean, that's something that we have done a lot of work on, and we've designed it. I mean, the whole of auto enrolment is designed on behavioural effects of inertia, and we've seen very low opt-out rates. So one of the things that we did was, when we set up the website, we actually made it what I describe as physically easy but emotionally hard to opt out. So we talked about for people, you know, you just opt out. It's just two presses of a button. But at the first press, you know, do realise that you're walking away from money that your employer will be giving you. You're leaving money on the table. And if you click through, so if you still want, you know, you overcome that loss aversion and you still go through, then we also said, and do you realise, you know, you can stay in, and then in the future, if you want to opt out or, you know, cease contributions, you can do that. So you're not signing up for life to do this. And the dropout rate of people who started opting out and then ceased opting, didn't opt out, was pretty impressive, actually. So, and we work with a behavioural economist to kind of get that effect and just make sure that, you know, if people really, some people, it was probably right for them to opt out, and that's absolutely fine, but don't do this blindly because you think, you know, you'd rather spend the money down the pub, you know. Actually there's some benefits to staying in.
Very briefly, do either Faith or Robert have any?
Well, I think it's well proven, auto-enrolment, auto-escalation and less engagement. I think that's where people might disagree, but actually giving people the value of their pension pot every week, probably encourages them to do behavioural things that are actually bad, i.e. sell when markets are down, because we know that that's a behavioural thing. So actually dealing with that is as much of an issue as getting them to save.
Yeah.
Yeah.
And you know, so the whole retirement income product needs to be low touch, low engagement. It just pays the check, you know, and don't ask people to make decisions, particularly as they get older. It becomes harder and harder to make sort of complex financial decisions.
Okay, Faith, any closing comment?
Well, our scheme obviously is quite different. I mean, we have a very high participation rate of about 95%. We've had that for a long time. A lot of that is about our engagement with our beneficiaries to explain what the benefits are and really try to get them sort of engaged as to how this is contributing. Our whole approach to responsible investment does help that, particularly with our beneficiary group, because that very much engages them. They feel that there is something very constructive happening with investments as well, then so they feel part of that, and that's actually been quite an important factor in that retention.
Okay, thank you. Now that's all we've got time for, unfortunately, with this session, because I was enjoying myself. But thank you to people here for asking questions and to our audience online for listening. I'm now going to hand over to Joanne to introduce our next speaker. But before that, can I ask you to thank the panellists in the usual way?